Hello and good morning, guys. Good morning, everyone. Please confirm if I am audible and visible to you. Am I audible and visible to you? Good morning, Ankita. Good morning, Pankaj, Vivek, Yogesh, Shomit, Jyotish, Vishnu. Good morning, Kuldeep Singh. Good morning. Please confirm if I am audible and visible to you. Om, good morning. Pooja Jangam, good morning. Komal Tripathi, good morning. Ronak says, good morning, good afternoon, good evening. In one go, he has wished me entire good day. Very good, Ronak. Okay, everyone is saying, I am audible. Yes. Yes, good morning. Good morning, Megha. Perfect, guys. Great. All right, so welcome to this session of PGBP chapter quick revision. We have already completed the first three parts of the revision. This is the fourth part, guys. And if you have not seen the first three parts, then please check out the YouTube, my YouTube channel and the playlist. All the parts are saved over there for the entire revision of PGBP chapter. And yes, today is the fourth and the final part, which is there for all of us. Okay. And in this particular part, we are going to focus on disallowances. Okay. In the earlier parts, we had focused on deductions, which are allowances. And in this particular part, we are going to focus on disallowances. So, what are disallowances? Guys, certain expenditure, despite of the fact that they are incurred for business purpose, they are used for running business, they are used for carrying on the business, despite of all those features which are present in those expenditure, Income Tax Act says, I will not permit you to reduce your profit to the extent of that expenditure. I'm not going to allow you deduction of that particular expenditure. Those are known as disallowances. So, but why Income Tax Act does so? Why Income Tax Act says that I'm not going to allow expenditure of this particular expense despite of the fact that this expenditure is very much allowable under the Income Tax Act. It fulfills the condition that these expenditures are wholly and solely incurred for business purposes. These expenditure are utilized for running business. So despite of all these features which these expenditure have, why are they being disallowed? Guys, they are being disallowed because the assessee or the businessman does not do certain basic compliances. One of the compliances which a businessman is required to do in his every expenditure is TDS, tax deducted at source. If a businessman doesn't deduct tax deducted at source, doesn't deduct tax at source from his expenditure, then Income Tax Act will say we are not going to allow the expenditure of that particular portion where TDS has not been deducted. Sir, what do you mean by TDS? So guys, before coming on to today's first disallowance, name of the disallowance is disallowance for TDS default, TDS deduction, either you have not done, TDS deposit you have not done. Before coming on to this particular disallowance, which is section 40A disallowance, I would like to discuss the concept of TDS with all of you. All right. Yes, first we are going to discuss the concept of TDS, or in the Western countries, it is popularly known as the withholding tax. In India, it is known as tax deducted at source, TDS. Both means one and the same thing. So guys, first we need to understand what is this TDS, and then we are going to jump on to our conclusion. How would an expense be disallowed if TDS is not complied by the businessman? Now, you can see a photograph over here. You can see a photograph over here. Please tell me in the chat box, who is this gentleman who's seen in the photograph? If you are aware about him, who is this gentleman? Please name it in the chat box. Please name it in the chat box. Who is this gentleman? What is the name of this gentleman? Good morning, Vanshi. Good morning, Kirti. Padmavati Srinivasan, good morning. Okay, who is this gentleman? What is name of this gentleman? I want both the names, okay? Not only the last name. Wow, Megha Tomar is very smart. She has written Ambani G. I don't want the last name. I want the first name also. Yes, he is the business tycoon of the country, Mukesh Ambani. He owns a big conglomerate by the name of Reliance. Reliance has various subsidiaries, various businesses where Reliance is into. Yes, it is one of the biggest conglomerates of the Indian country, one of the biggest businessman of the Indian country, who's Mr. Mukesh Ambani. Now, guys, if we talk about Reliance Industries Limited, it has a lot of employees. As per my knowledge goes, Reliance Industries Limited has more than 2 lakh employees. And Reliance Industries Limited is paying salaries to the 2 lakh employees. Obviously, Reliance Industries Limited is paying salaries to the 2 lakh employees. Now, the question is that, sir, is this salary an allowable expenditure from an income tax perspective in the profit and loss account, which is prepared for Reliance Industries Limited? Is it an allowable expenditure? Answer is a big yes. It is definitely an allowable expenditure. So, salary expenditure will come in the debit side of the profit and loss account of Reliance Industries Limited. It will be allowed as an expenditure because it is absolutely a business expenditure which pertains to Reliance Industries Limited. So the profit and loss account which Reliance Industries Limited will make, it will have a debit balance. It will have a debit hit of salaries which are paid to 2 lakh employees. Wow. Guys, 2 lakh employees are earning salary from Reliance Industries Limited. Now, the catch is that Reliance Industries Limited is paying salaries to these 2 lakh employees. Now, the salaries which are being paid to the 2 lakh employees of Reliance Industries Limited, tell me something, whether these salaries are taxable in hands of the respective employees or not. Whether this is taxable income in hands of the respective employees or not. Answer is a yes. So the employees should offer this income to tax as salary, and yes, they should pay taxes on this salary to Government of India. Reliance Industries Limited is paying salaries to the employees. Employees should pay taxes on these salaries to Government of India. Of course, yes, the employees should pay it. The 2 lakh employees of Reliance Industries Limited should pay the tax to Government of India on their salaries for sure. Now, guys, Income Tax Act. What is the responsibility of Income Tax Act? Responsibility of Income Tax Act is to administer whether these 2 lakh people are paying their taxes truly, duly, or not. Income Tax Act to make sure that these 2 lakh people are paying taxes to the Government of India on their salaries perfectly, aptly, or not. Now, guys, the point is, it is really difficult to track 2 lakh people's salary, their taxes, which is paid to Government of India. It is very, very difficult to track. Government of India is, in a difficult situation. It has to track 2 lakh people together who are paying salary, who are being paid salary. To track these 2 lakh people is a very, very difficult task for Government of India. To make sure that they have paid taxes, to make sure that they have duly filed their return of income, to make sure that they have duly paid whatever taxes are due, calculated properly. Proper calculation should be there. This is a difficult task for Government of India because 2 lakh people is a huge amount. And guys, Reliance Industries Limited is not the only company in the country. There are several such companies who are employing several thousands and lakhs of people in their payroll. Imagine how difficult is it for Government of India to track each and every employee's taxes. How difficult is it? It is very difficult. It's a lump sum. It's very, very voluminous. Since it's very, very voluminous, what do Income Tax Act do? Income Tax Act would transfer its responsibility to Mr. Mukesh Ambani. Income Tax Act will ask Mr. Mukesh Ambani, dear Mr. Mukesh Ambani, you please become my agent. I am using some raw words, okay? These are not law of language. I'm using some raw words in front of you just to make you understand. Income Tax Act is saying, dear Mr. Mukesh Ambani, please you become our agent. You deduct taxes from the salaries you pay to your employees and pay to Government of India. I'll give you an example. Suppose one of the employees of Reliance Industries Limited is having a salary of 7 lakh rupees. If we calculate the taxes which are due to this particular employee, suppose the taxes which are calculated is 13,000 rupees. Suppose I've not seen the calculation. I'm just taking a rough figure. Okay. So suppose the income tax which is to be paid by this particular employee, okay, let's increase the amount a little bit for rounding of consideration, is 30,000 rupees. Okay. 30,000 rupees is the tax which this employee has to pay to Government of India, right? Now, what is the Government of India requesting Mr. Mukesh Ambani? Government of India is requesting Mr. Mukesh Ambani, dear Mr. Mukesh Ambani, you please pay only 6,70,000 to your employee. Mukesh Ambani is saying, then where should I pay the balance 30,000? Government of India is saying, pay this 30,000 to Government of India Treasury, to Government of India account. Mukesh Ambani is asking, why should I do so? Government of India is saying, you should do so because I don't want to run after each and every employee. You become my agent. You deduct tax from the salary of the employee and pay it to me. I will be relieved of the burden of running after each and every employee and making sure that they have paid their taxes on salary in an appropriate way. Mukesh Ambani is absolutely furious. Mukesh Ambani is absolutely, angry on income tax department. Mukesh Ambani is saying, income tax department, look, income tax department, I have lots of work to do. I have such big companies whom I need to administer. I have big work to do. My taxes, I have to pay my taxes also. I have to administer my taxes also. I don't have time to do all this charity work for you. I'm not going to become your agent. You please collect your taxes yourself. I'm not going to do that. Mr. Mukesh Ambani is a little disheartened. Mr. Mukesh Ambani is a little angry because he has to do his work. Leaving his work, Income Tax Act wants to make him do their work. Not fair at all. Mukesh Ambani is saying, I'm not ready to do all this stuff for you. I am going to pay entire 7 lakh rupees to my employee. Income Tax Act, you approach the employee and you recover 30,000 from that particular employee. I'm not going to do all this nonsense because I'm not interested in doing work for you. I'm doing work for myself. I will help my business. Why should I help you? Why should I help you? Now, Income Tax Department is the law of land. Income Tax Department is not going to leave this matter so easily. Income Tax Act Department tells Mr. Mukesh Ambani, okay, Mr. Mukesh Ambani, if you are being arrogant, if you are being adamant, if you are being non-cooperative with Income Tax Department, you will have to face the brunt. What is the brunt? What is the punishment which Mukesh Ambani has to pay? Income Tax Act is saying the expenditure which you think that is allowable, the expenditure which you think is allowable, I'm going to disallow it if you do not deduct TDS and deposit it to Government of India. If you do not deduct TDS and deposit to Government of India. So the entire amount of salaries will be disallowed if you don't deduct tax and pay it to Government of India. This is the punishment that you have to follow if you do not follow the instructions of the Income Tax Department. So in a way, Mukesh Ambani is being forced. Mukesh Ambani is being forced to ensure that compliance of its employees is also made along with its own compliances. This is the concept of TDS. Yes, I have used some raw words like agent. Okay, there's no such word in law. There's no agent-principal relationship between Mukesh Ambani and Income Tax Department. Please don't take me wrong. These are just an example. These are just a way of telling you so that you're able to understand properly. But the crux of the matter is every expenditure which is there in the P&L account, almost every expenditure is subject to TDS. Yes. On behalf of some other person, Mukesh Ambani has to deduct TDS and deposit it to Government of India. What is the benefit of Government of India? A, Government of India's administration is reduced. B, everyone comes under the tax net. Everyone is paying taxes. This is ensured because, all these 2 lakh employees, some employees might not be paying taxes. Some employees might be evading taxes. Now, by introducing provision of TDS, the employees cannot escape their tax liability, because Mukesh Ambani will make sure that tax is deducted and paid to government treasury. So government has the information of all the 2 lakh employees of Mukesh Ambani. Government has the information. When government has the information, TDS ensures that tax evasion is curtailed. There is no one who's not paying taxes to Government of India. This is made sure by these provisions of TDS. So yes, crux of the matter is, if on any expenditure TDS is not deducted, or after deduction it is not deposited to government treasury, the expenditure will be disallowed in hands of the businessman. This is the first disallowance which we are going to do today. All right, it is default in TDS deduction or deposit. Whenever a businessman defaults in deducting TDS from the expenditure or depositing it to government treasury, then there is a disallowance which is which arises for this particular businessman. This disallowance is a punishment. In a way, it's a punishment for not deducting TDS, for not deducting taxes at source with respect to the expenditure. So default in TDS deduction or TDS deposit, section 40, subsection A, small a, okay, small a All right. Now this section is divided into two parts. First one is for non-resident. So if Mukesh Ambani is paying some expense to a non-resident, like it has a non-resident employee or it has a non-resident person who's providing some services, if Mukesh Ambani is making a payment to a non-resident but not deducting taxes from that particular payment, or if Mukesh Ambani is making payment to residents and not deducting tax from those payments, so section is divided into two parts. Now guys, in case of non-residents, taxes have to be reduced from the payments which are made to non-residents. Okay, taxes have to be reduced for sure. When the taxes have to be reduced, and if you do not reduce taxes from the payments which are made to non-resident, 100% of the expenditure is disallowed. Yes, 100% of the expenditure will be disallowed. We will not allow even a single rupee of that particular expenditure. I'll give you an example. Suppose Reliance Industries Limited hires a very sophisticated engineer from Germany. Okay, that engineer provides services in India. The payment is made in foreign currency to that German resident. He's a non-resident in India. He provides some services, comes to India, and fly back to his own country. So after he flies back to his own country, Reliance Industries Limited make a payment of 1 lakh rupees to that particular person. Now, before making that 1 lakh rupees, deduction of the appropriate TDS should be made. Suppose the deduction rate is 10%. Deduction should be made at the rate of 10,000 rupees, and only 90,000 is to be paid to that particular German person. So what should happen of that 10,000? That 10,000 is to be deposited to Government of India. 10,000 is to be deposited to Government of India. Only then rupees 1 lakh deduction will be eligible to be allowed in the P&L account of Mr. Mukesh Ambani. If the expenditure is not subject to TDS, then disallowance of that expenditure will happen to the extent of entire 100%. Entire 100% rupees are disallowed to that particular non-resident. Now, this provision with respect to residents will lead to disallowance of 30% only. Okay. So, in case the payment is made to resident, okay, I was taking example of Germany, right? Now, I take example of India. So, Mukesh Ambani is paying some visiting fees for an Indian engineer, not a German engineer, but an Indian engineer. His expense is debited on the P&L account. Okay, TDS is required to be deducted from this particular expense before making payment to that particular resident. But if TDS is not deducted or not paid, then 30% of the amount is disallowed. Sir, why is it so that in case of non-resident, the disallowance is 100%, and in case of resident, the disallowance is 30%? Why is it so? There's a mismatch. There's a mismatch over here. The disallowance is only 30% in case of resident. It is 100% in case of non-resident. Sir, why this disallowance is there? We are unable to understand why is disallowance is there. So guys, this disallowance is there because in case of non-residents, it's difficult to recover taxes from the non-resident because non-resident might go back to their respective countries. So it's difficult to recover taxes from them. Suppose it is a case of resident. We can go to their home. Their home is in India only. They are residing in India only. We can go to their home and collect taxes from them directly. If Reliance Industries Limited do not deduct taxes, we will go to their home. We will collect taxes from the engineer itself. So in case of resident payments, the disallowance is only to the extent of 30%. In case of non-resident payment, the disallowance is to the extent of 100%. A stricter regime for non-residents, a lenient regime for residents, because residents, Government of India is very sure if Reliance is not going to deduct tax, then they are going to income tax department will go to their home and directly collect the taxes. Therefore, the regime is easier for resident. And yes, Jyotish has reminded me correctly. The way, a shortcut way to remember which is the subsection. This is 40AI. This is 40AIA. A way to remember which one is 40AI and which one is 40IA is 40AI. We are dedicating to non-residents, and in India it is said that Atithi Devo Bhava, which means we respect our mehman who are coming to our home. So these are mehman for India. Non-residents are Atithi for India. So we are going to respect them. We are going to give the first section to the non-resident and the second section to the resident. Second section is section IA. This is a shortcut way of remembering the subsections. All right. Now, disallowance is made for both of these expenditures. Okay. Now, sometimes non-deduction of taxes is not deliberate. It is owing to some mistake. mistakenly the businessman is not able to actually deduct taxes. Sometimes this mistake happens. Okay, so this disallowance is a temporary disallowance. What do you mean by temporary disallowance? Temporary disallowance means this disallowance is going to reverse in the next years if the compliance is made in the next year. So what do you mean by that? I'll just explain. Temporary disallowance. Okay, so the disallowance of TDS which is made in the current year is a temporary disallowance, which means, I'll give you an example. Okay, I'll give you an example. In the year 2021-22, Reliance Industries Limited paid 2 lakh rupees to Mr. X. This was subject to TDS of 10,000 rupees, but Reliance Industries Limited did not deduct TDS on this particular amount while making payment to Mr. X. So obviously, guys, the amount will be disallowed. Amount will be disallowed in financial year 2021-22. But guys, in 2022-23, immediately next year, Reliance Industries Limited had to again pay 1 lakh rupees to Mr. X. It had to again pay 1 lakh rupees to Mr. X. But now this time, the TDS which is required to be deducted is 5,000 rupees from Mr. X account. Now, Reliance Industries Limited is reminded of the fact that it did not deduct the TDS in last year as well. So in the current year, it deducted TDS not only of the current year, but also of the previous year. So the total TDS deducted by Reliance Industries Limited in 2022-23 is 1 lakh minus 10,000 minus 5,000, which is 85,000 is remitted to Mr. X. 85,000 rupees is remitted to Mr. X after deducting TDS of the current year as well as of the previous year. So the disallowance which was made in the previous year of this particular amount, that will be allowed as a deduction in the current year's P&L account. This is known as temporary disallowance. Temporary disallowance means a disallowance which is made in one of the years, but in the subsequent years it is reversed. Why? Because you have deducted the TDS and deposited it to government treasury. That is the catch. This is known as a temporary disallowance. This temporary disallowance is allowed in the next year if the TDS is deducted and deposited to government treasury in the next year. That is the concept. Okay, sir, got it. So let's now move on to the allowance in subsequent period. Okay. So when the allowance should be made, guys, allowance should be made in the subsequent period. Whenever you deduct TDS in the subsequent period, whenever you deposit TDS in the subsequent period, then you get allowance for the expenditure which has incurred in which has been incurred in previous year. Allowance can be taken in the current year. So in the current year, 2 allowances can be taken. One of the expense of the current year, second of the expense of the previous year. Both the expenses can be allowed as a deduction in the current year if you make TDS payments in the current year. That is the concept. Okay, sir, got it. Now, guys, there are two things. First one is the deduction. Second one is the deposit. Now, please understand the difference between deduction and deposit. Okay, I'll explain this difference by way of a accounting entry. By way of an accounting entry, I will explain this difference to you. Okay, sir. All right. So, in the year 2021-22, you put an entry in your books of accounts, salary account debit, to bank account, to TDS. This is the accounting entry that you are going to put for your salary expenditure. This is the accounting entry which you're going to put for your salary expenditure. Suppose your salary is 20,000 rupees. Okay. Employee is going to get 18,000 rupees, and the TDS which is deducted from this salary is 2,000 rupees. Employee is going to get 18,000 rupees. This is going to be credited in employee's bank account. Okay. So employee is going to get 18,000 rupees, and you are going to credit TDS payable account as 2,000 rupees. This is the accounting entry which you're going to put. And guys, on the due date of the date when TDS is to be paid to Government of India, you will pay TDS, you will pass another entry, TDS account debit to bank. TDS account debit to bank. This 2000 rupees you're going to pay to Government of India. This 2000 rupees you're going to pay to Government of India. This is the second entry which you're going to make. So first entry which you're going to make is salary account debit 20,000 rupees to bank. Okay, you're going to pay the salary to employee, but not full 20,000, only 18,000. Okay, to TDS 2,000 rupees you're going to deduct TDS from salary and pay it to Government of India. Next is TDS account debit to bank. You're going to pay TDS account also debit also to bank of your government treasury. Okay, so guys, this entry is the deduction entry. This entry is the deduction entry, and this entry is the deposit entry. This entry is the deposit entry. When you deposit this TDS to Government of India, this is the deposit entry. This is the deduction entry. Now, in case of deduction entry, if you do not deduct TDS and you pay the entire amount 20,000 to employee's bank account, then it is known as default in deduction. And if you pass this entry, but you fail to deposit TDS to government treasury, if you fail to deposit the TDS to Government of India, then it is known as default in deposit. So two defaults are there. First, default in deduction of tax. Second, default in deposit of tax. So two defaults are there which are dealt with over here. Now guys, obviously you can rectify both of these defaults. If deduction is not made, in the subsequent year you can make the deduction and claim the entire expense in the next year. If you have made the deduction but you have not made the deposit of TDS, then whenever you make the deposit of TDS in that year, you are going to claim the reduction of the expenditure. Okay sir, got it? Okay, so let's come back to our provision. Let's come back to our section. Section deals with two kind of miscompliances. Miscompliance number one, deduction or deposit. Okay, now miscompliance number one is that you have not made the deduction, you have also not made the deposit, and you have made both the things in the subsequent year. You have not deducted the TDS, you have not deposited the TDS, and you have done both of these things in the subsequent year. You did not do it in the current year. The year in which expenditure was incurred, you did not deduct TDS in that particular year. So guys, in the year when the deposit of TDS is made, in the subsequent year when TDS deposit is made, in that particular year, the expense will be allowed to this particular assessee. So expense will be allowed in the year of deposit of TDS. Whenever deposit is made of that particular TDS, then the expense will be allowed as a deduction. So deduction is not made, deposit also not made in the current year when the expense was incurred. It was made in the subsequent period. So in the year when deposit of TDS is made, then the expense will be allowed. Now there's another miscompliance, that deduction you made in the current year, but deposit you made in the subsequent year. Okay. Now the condition is you have complied with first section. Deduction you have done. The first entry which we wrote over here, the first entry which we wrote over here, you had made the first entry in the year itself, in the current year itself, but you did not deposit. Deposit entry you did not made. You did not deposit the TDS to government treasury. Then deduction is made, deduction in the current year, but deposit in the subsequent year. Deposit you made in the subsequent year. Then what will happen? And let us also take an example. Okay. Let us take an example also, guys. Okay. So, in the year 2021-22, you had to deduct tax on 1 lakh rupees. You had deducted tax on 1 lakh rupees, but till 31st of March 2022, no TDS was deposited to government treasury. TDS was not deposited to government treasury. Expense was 1 lakh rupees. TDS was deducted from the books of accounts. Now, guys, for this particular year, suppose the return filing date is 31st October 2022. Suppose the return filing date is 31st October 2022. So you have to deposit this particular amount till 31st October 2022. Suppose if you have deposited the TDS till 31st October 2022, which financial year is 31st October 2022? This is the next financial year. Okay, it is 22 to 23. Deduction is made in 21-22. Deposit is not made in 21-22. Deposit is made beyond 31st March 22, which means the deposit is made in the financial year 22-23. Guys, in this particular year, financial year 22-23, when the deposit is made to government treasury, which year will the expense be allowed? Now let me explain it to you. If the deposit is made before the filing of return of income, if the deposit is made before the filing of return of income, which is before 31st October. So if the deposit is made by 31st October, then the allowance of expenditure will be made in 21-22. And if the deposit is made, say on 1st of November 2022, then the deduction of expense will be allowed in 22-23. So guys, return filing date, till return filing date, AO is able to ascertain whether you have deposited the TDS or not. So he will see whether you have deposited the TDS or not. If you have deposited the TDS till the return filing date, then guys, till this particular date, the deduction will be allowed in the year when the TDS was deducted. The expense will be allowed in that year itself. But if the TDS is not deducted in this particular year, and TDS is deducted in this year, but it is deposited in the next year, beyond the return filing date, then the expense will be allowed in the subsequent year, which is 22-23. That is the provision which is there in law. Let's read the section now. Let's read the section, guys. So you have made the deduction in the current year, but you have not made the deposit in the current year. You have made the deposit in the subsequent year. What will happen? Two cases, guys, two cases. Deposit of TDS till the due date of filing of return of income of current year. If you have deposited the TDS till the due date of filing of ROI in the current year, then expense to be allowed in the current year itself. In our case, current year was 21-22. And if the deposit after due date of filing of return, if the deposit is made after the due date of filing of return, then expense is allowed in the year of deposit of TDS. Whenever you deposit the TDS, then in that particular year, the expense will be allowed if the deposit is made after due date of filing of return of income. That is the law. So you have to see what is the return filing date of that particular current year. If the return filing date, till the return filing date, if you deposit the TDS, then it's okay. Then the deduction will be allowed in the year of expense itself. But if you deposit the TDS after the return filing date, then guys, the expense will be allowed in the year when the TDS is deposited to government treasury. That is the law. So yes, a little different kind of provision which is there in this particular case, but yes, an important one which is very, very important from an exam standpoint. Okay, sir, got it? So guys, now we move on to our next sections of our syllabus. Two very, very important section: maintenance of books of accounts and audit of books of accounts. These are two sections which are very, very important from an exam standpoint. And maintenance of books of accounts is section 44AA, read with rule 6x. Okay, maintenance of books of accounts. Guys, what do you mean by books of accounts? As I've already told you, Income Tax Act would want to see your profit and loss account, would want to see your balance sheet to ascertain whether you have claimed right expenditure or not in your books of accounts. Income Tax Act would want to see your profit and loss account, would want to see your balance sheet, would want to see your business details, would want to see your things which you are doing in your business, and they would want to see your books of accounts. So books of accounts are required to be maintained by a certain category of people as per the income tax. Okay, they are separate books of accounts. Financial books of accounts are separate. Income tax books of accounts are separate. These are two different books of accounts which are there. So maintenance of books of accounts, section 44A, read with rule 6F. Now this is divided into two parts. First is for specified business. Other one is for other business or profession. Okay. So for specified persons, the limits for requirement of maintenance of books of accounts is given in this particular chart. Let's read the limits. Okay, sir. Now, for specified persons, if you have an existing setup Existing setup means you are already a businessman and you're doing your business for a very long time, business or profession as the case may be, from a very long time. So you have an existing setup. Then what are we going to see? We are going to see gross receipts of all the past 3 years. Your gross receipts of all the past 3 years should be more than 1 lakh rupees per year. If your gross receipts of all the past 3 years is more than rupees 1.5 lakh per year, then you are required to prepare your books of accounts as per Rule 6F. You are required to prepare your books of accounts as per Rule 6F if your gross receipts for all past 3 years exceeds rupees 1.5 lakh per year. And if your gross receipts of any of the past year is less than 1.5 lakh rupees, then you are required to prepare your books of accounts normally to compute the taxable income. That's it. Then, Rule 6F. Rule 6F is the stringent provision where more amount of books of accounts, more specified books of accounts are required to be prepared by an assessee. So if you are not having your gross receipts for more than 1.5 lakhs in any of the 3 previous years, in any one of the 3 previous years, then you are going to prepare your books of accounts normally, okay? Not as per Rule 6F. Rule 6F is the critical rule, is a more complicated rule as compared to the normal books of accounts. So these are the two limits which you are required to fulfill. Now, if you are a new setup and you do not have past years books of accounts, then what will we see? We will see your rates. We will see your expected gross receipts. If your expected gross receipts are likely to exceed 1.5 lakhs per year, then you are required to prepare your books of accounts as per Rule 6F. If your expected gross receipts are less than 1.5 lakh per year, then your books of accounts are required to be maintained, as per normal standards. Okay, normally to be prepared to compute the taxable income, normal books of accounts are required to be prepared. But if you fall under 6F category, then guys, certain additional books are required to be prepared if you fall under Rule 6F category. Okay, sir, got it. Okay, now we come on to other business and profession. So if you are not specified business and profession and you are other business and profession, then the receipt which are applicable to you is gross receipts of any past 3 years. If any of the past 3 years gross receipts exceeds 25 lakh per year, in case of HUF, rupees 25 lakh per year. Now we are dealing with gross receipts of any of the past 3 years. If gross receipts of any of the past years exceeds rupees 10 lakh per year, in case of HUF, rupees 25 lakhs, or income of any past 3 years is more than 1.2 lakhs per year, then guys, you are required to prepare your books of accounts in a normal way. Books of accounts are required to be prepared in a normal way if you are falling under this particular category. Now let me just remove these circles which are visible on the board. Now you can see the limits clearly. So the rule is for other businesses. For other businesses, yes, absolutely, Pankaj. So there's a big difference between this limit and this limit. Pankaj, you are absolutely right. Difference is that over here, we need to see gross receipts of any past 3 years, okay? If even in any one of the year, the gross receipt is over 10 lakh rupees, then you are required to prepare your books of accounts. If any 1 year exceeds 10 lakh rupees. However, in the earlier case, in this particular case, only when all the past years gross receipts was more than 1.5 lakhs, then Rule 6F applies. So there's a big difference between this part and this part. This says any of the past 3 years, and this says all of the past 3 years. Over here, the strict condition is for any of the past 3 years. If even 1 year in the past 3 years is exceeding 10 lakh rupees, then you are required to prepare your books of accounts. Okay, sir. Then in this case, if you are a new setup, then expected gross receipts should exceed 10 lakh rupees, or expected income should exceed 1.2 lakh rupees for any one of the past 3 years. Then you are required to prepare your books of accounts. Now, if gross receipts of all the 3 years is less than 10 lakh rupees, and income of all the past years is less than 1.2 lakh per year, and expected income is also less than 1.2 lakh per year, then no books of accounts are required to be maintained. No books of accounts are required to be maintained in this particular case, the last case. Again, the thing to be noted is gross receipts of all past 3 years should be less than 10 lakh rupees. If gross receipts of even if 1 year is more than 10 lakh rupees, then also, guys, we will be required to prepare our books of accounts. So if you don't want to prepare books of accounts, all past years, all past 3 years, gross receipts should be less than 10 lakh rupees. That is the principle which we are going to follow in this particular case. Okay, sir, got it. So, guys, this is the provision for books of accounts. This is the provision which is related to books of accounts, which are required to be prepared as per the Income Tax Act. Books of accounts which are required to be prepared as per the Income Tax Act. And now we come on to tax audit. What are the limits which are specified in tax audit? Okay, in case of tax audit, now, guys, Income Tax Act definitely pays regard to the statutory audit which happens as per the Companies Act. So you must have read the statutory audit which is done by chartered accountant as per the Companies Act. That audit is very much there. There is no embargo that audit will be conducted. That audit will definitely be conducted by the Companies Act as per the Companies Act regulation. But if Income Tax Act thinks so, if it thinks fit, then it will order special tax audits from a CA. Again, this power is also given to a chartered accountant. Okay, then it can give tax audit to a chartered accountant, and chartered accountant will perform tax audit to your books of accounts. The perspective in tax audit will entirely be tax. Tax audit will be focused on tax, the allowances, disallowances, everything which is related to tax. Tax audit will focus on that particular thing. It will not focus on any other compliances, any other ROC compliances, or internal audit, internal controls compliances. Tax auditor is not bothered about all those things. Tax auditor is only and only bothered about your tax compliances. So who all are required to get their tax audit done? The conditions are, let us see. The first condition: your turnover limit is 10 crores. Your turnover limit is 10 crores, which means you are required to get your tax audit done only when your income, your turnover exceeds 10 crores. If your cash receipts and cash payments are less than equal to 5% of total receipts and total payments, respectively. If your entire business is based on pure and pure banking transactions, if your entire business is based on pure and pure banking transaction, and you do your cash transaction only up to the extent of, say, 5% of the total receipts, or 5% of the total payments, that's it, even less than 5%, okay, 4%, 3%, then your turnover limit for getting your tax audit done is 10 crore rupees. Your tax audit will be required to be done above 10 crore rupees. Now, if you don't have cash receipts and cash payments which are your cash receipts and cash payments are more than 5% of your total receipts and total payments, then the turnover limit will be 2 crores and 1 crore respectively. 2 crores in case where section 44 AD applies. Wherever section 44 AD, the presumptive taxation regime you are applying, there your turnover limit will be 2 crores. And in any other case, in any other business, the turnover limit will be 1 crore. These are the tax audit limits which you are required to fulfill. These are the tax audit limits which are there in your case. So the general limit is 1 crore. Okay. If your turnover is above 1 crore, then you are required to prepare your tax audit, get your tax audit done. So the general limit is 1 crore. Two exceptions to it: if you are covered under 44 AD section, then your turnover limit increases to 2 crores. And if your cash receipts and cash payments is less than 5% of the total receipts and total payments, then your turnover limit is even higher, 10 crore. Guys, please write in the chat box. My question is that higher the limit better it is, or lower the limit better it is from the point of view of the assessee? Higher the turnover limit better it is, or lower the limit better it is from the point of view of the assessee? Please write in the chat box. Please write higher or lower. Which one is better, higher or lower? Which limit is better from the point of view of assessee, higher limit or lower limit? Which is better from the point of view of assessee, higher limit or lower limit? That is my question to you. Please write in the chat box. Jyotish says higher, Pankaj says lower, Rohit says higher, Megha says lower, Kirti says lower. So mixed. Pankaj has changed his stand. Wow, very good, Pankaj. Pankaj changes his stand so often. Pankaj now says higher. Pankaj, please decide whether it's higher or lower. So, guys, the correct answer is higher the limit, better it is. Why higher the limit, better it is? Because, guys, if the limit is higher, then lesser assessees will fall under tax audit ambit. If high limit is there, then lesser assessees will fall under tax audit ambit. So, higher the limit, better it is. That is the principle which we are going to follow in this particular case. So, higher the limit, better it is. So, if 10 crore is the limit, then that is best for me because I will not be falling under the category of tax audit. Okay, sir, got it. Okay, a simple illustration, guys. A simple illustration which you are going to do now. Okay, a simple illustration. These are the details which are given to you for a company. Purchase of material, cash, other, total. Then purchase of material, payment is made, cash payment, other payment, total payment. Okay. Purchase of finished goods. There are some things which are purchased. Cash, other, total. Okay. Sales are made. Okay. Sales of good 1. Sales of good 1. Sales of good 2. Good 2 is being sold. Cash, others. In total, it's given to you. You need to ascertain whether tax audit is applicable on this particular enterprise or not. Whether tax audit is applicable for this enterprise or not. So, guys, as we can see that, the total turnover of the company is 716 lakhs. 716 lakhs, which means 7 crores and 16 lakhs is the turnover limit of this particular company. 7 crores and 16 lakhs. Now, let's see whether the percentage of cash payments are less than 5% or not. So we have divided 4 by 463. Okay. So yes, it is less than 5%. It is less than 5% of the total payment. Now let's see the receipts, percentage of cash receipts. It's 38 divided by 716. It's more than 5% of the total receipt. So guys, when it is more than 5% of the receipts, then 10 crore limit is not applicable. 10 crore limit is not applicable because for applying the 10 crore limit, the condition is that your total cash receipts and payments should be less than 5% of the total receipts or payments. So yes, in this particular case, tax audit will be applicable on this company because the cash receipts are more than 5% of the total receipts. So the tax audit will be applicable for this particular company in this particular example. This is how we are going to analyze the applicability of tax audit and how tax audit is required to be done. All right, let's come on to the last topic of this particular chapter, guys, and the last topic which we are going to cover in our revision is firm assessment. Partnership firm assessment. How would assessment be done for a partnership firm? Okay, how would assessment be done for a partnership firm? Sir, why are we specifically dealing with firm assessment in a separate manner? Why can't we assess firm in a similar manner as we do for any other business under the head PGBP? Why partnership firm is given a specific stand over here? Why partnership firm is being discussed separately? That is the question which comes to our mind. Guys, the specific feature of partnership firm is that partners and firms are one and the same thing. They don't have a separate legal stance. They don't have a separate legal entity. For example, a company is a separate legal entity from its shareholder, okay? But partnership firm has got a thin line of difference between partners and partnership firm. This is the reason why we are going to deal with specific provisions for partnership firm assessment. If we do not have specific provision for partnership firm assessment, then assessees are going to misutilize the expenses and incomes provisions which we have in PGBP, and they're going to reduce their taxable income. Now, let us first understand what kind of payments are made from partners to partnership firm or vice versa. Okay. So, guys, partners provide services to partnership firm, and in return, they get remuneration, they get interest on capital, they get profit sharing. In return, partners get remuneration, partners get interest on capital, and partners get profit sharing in the partnership firm. That is the equation which is there between partners and the partnership firm. Now, firm should follow the following conditions. There should be an instrument or deed of a partnership. That is a essential thing, guys, for a partnership firm. Okay, if you want to make your partnership a legal partnership, in which enforceability of law is there with respect to the provisions of the partnership, then guys, its instrument should be there and deed should be there and should be a registered deed. Profit sharing ratio should be specified in the deed itself. In what ratio would the partners share the profits? Those ratios should be specified in the partnership deed itself. That is the second condition. And the third condition is that there should be no failure under section 144. So guys, 144 deals with best judgment assessment, which means that if notices are not responded to and the Income Tax Act has given you some ultimatum for filing your return of income or anything of that sort, then you did not comply with those provisions. So those provisions, if you are falling under 144 best judgment assessment sections, then guys, these provisions will not be applicable to you, and assessing officer is free to do assessment in the way he wants. Okay, these provisions will be applicable only when 144 is not applicable. That means best judgment assessment is not applicable. And in the chapter of assessment proceedings, we are going to discuss in detail what do you mean by best judgment assessment. Now let's come on to our main provisions of the firm assessment. Allowability of expenditure in the hands of the firm and the income which is given to the partners. Okay, I've divided my discussion into two parts. Okay, partnership firm will pay interest on capital to the partners. Partnership firm will pay remuneration to the partners. Okay, these are the two expenditures which partnership firm will make, and this will be income for the partners. This will be expenses for the partnership firm. This will be income for the partners. Then share in profits will be given by the partnership firm to the partners. This will again be appropriation of profit from the angle of partnership firm. It will be the income in the hands of the partners. That these are the two major payouts which we are going to deal in with this particular section. Okay, now if you want to allow allowability to the partnership firm, okay, this is an expenditure. We want allowance in the partnership firm books of accounts. If you want allowance in the partnership firm's books of accounts, you need to fulfill the following conditions, which are: the interest on capital should be authorized by the partnership deed. Without authorization, you are not paying anything. That is the first condition. Then payment after the deed. The payment is made after the deed has been made and after the authorization is there in the deed. Only then payment is made. Payment within the statutory limits. The payment should not be more than the limits which are given for interest on capital and remuneration which are given in the Act. So Act is saying pay interest to your partner, pay remuneration to your partner, but subject to certain maximum limits. You cannot pay unlimited amount to your partners. Guys, there can be a situation where partners tax rate is less. Partnership firm's tax rate is high. In that case, partnership firm will be lured to pay higher amount of remuneration to the partners, to pay higher amount of interest on capital to the partners, just to save taxes. So Income Tax Act has restricted the amount of interest on capital which can be paid to a partner and allowed to a partner, and remuneration which can be paid to a partner and allowed to a partner. Income Tax Act has made those kind of restrictions. Now we'll come on to the statutory restriction in a short while. Now the question is whether both of these things will be allowed in hands of the partnership firm. Answer is, if these are under the statutory limits, then it is allowable in hands of the partnership firm, but taxable in hands of the partner. So partner will be paying taxes on this particular amount, and it will be allowed as a deduction in hands of the partnership firm. That is the principle. The amount disallowed in the hands of the firm is exempt from the partners. Suppose if you pay amount which is more than your statutory limit, then the amount which is more than the statutory limit will be disallowed. And if the amount is disallowed, then partner will not have to pay taxes on that particular amount. Partner will have to pay taxes only on the amount which is received by the partner and allowed in the hands of the partnership firm. So the first condition is that the income should be allowed in hands of the partnership firm. Only then it will be taxable in hands of the partners. That is the principal condition. Now, what are the statutory limits, guys? Statutory limits are given in the box. I hope you are able to see the box clearly. Okay, let me shift it a little bit. Yes, now you can see the statutory limits very, very clearly. In case of interest on capital, you can give it at max up to 12% per annum of the capital which is introduced in the business. Suppose if I pay 15% per annum as the interest on capital, 3% will be disallowed. 3% will be disallowed. If I pay taxes, if I pay interest which is which is more than 12%, say 15%, 3% will be disallowed. Yes, guys. So 12% interest on capital is allowed as a deduction. More than 12% will be disallowed. Then remuneration to the partners, the salary which is given to the partners. Salary should be given according to the book profits of the partnership firm. If book profits, first 3 lakhs of book profits, 90% of book profit or 1.5 lakh rupees. That is the maximum remuneration that can be paid on first 3 lakhs of the book profits. Then the balance book profits, 60% of the book profits can be paid as remuneration. Remuneration cannot exceed salary. Remuneration means salary. Salary cannot exceed 60% of the book profits. Then if in case of a loss, 1.5 lakhs can be the maximum amount of remuneration which can be paid to the partners. Maximum amount which can be paid is 1.5 lakhs. If you pay more than 1.5 lakhs to your partners, then we will disallow that entire expenditure in hands of the partnership firm and allow it in hands of the partner. So that is how the remuneration is limited by statute. Okay, sir. What about share in profit? Guys, share in profit is not allowed as a deduction for the partnership firm. And if it is not allowed as a deduction in case of partnership firm, it is not taxable for the partners as well. It is not taxable for the partners as well. It is not allowed as a deduction of the partnership firm. It will not be allowed as the, it will not be taxable for the partners as well. Equity is maintained, guys. Equity is maintained. If it becomes a deduction for the partnership firm, then it will become taxable for the partners. But if it is not allowed as a deduction for the partnership firm, then it will not be taxed in the hands of the partners as well. This is how the provision is laid down. Okay, sir, got it. So guys, this was the entire provision of firm assessment. Partnership firm, how is partnership firm assessed in case of the limits which are given, statutory limits? How is partnership firm assessed? That is the entire concept of partnership firm. And yes, from standpoint of the intermediate students as well as final students, this is, yes, one of the most important topics of your syllabus, partnership firm assessment, especially for intermediate students. Especially for intermediate students, a small questions from partnership firm assessment can be asked in the examination. So be prepared for a small question from this particular topic, which is the firm assessment. And guys, hereby I'll conclude today's session. And yes, guys, this Sunday there'll be a test. This Sunday there'll be a test. Okay, Sunday, date is 25th. Okay, 25th April 2022. There'll be a test of PGBP chapter, section 32 AD onwards till the last, including the presumptive taxation as well. So the entire chapter of PGBP starting from 32 AD till last, including the presumptive taxation as well. This is the test which is scheduled on Sunday, 25th of April. That is how the, no, Jyotish, only excess amount will be disallowed, not the entire amount. Only the excess amount will be disallowed. All right, guys, let's now prepare for the test of PGBP chapter, which is scheduled on Sunday. And yes, in the next week, we are going to start our chapter on capital gains. We will not have the live session on Thursday, which is day after tomorrow. We will not have a live session on Thursday. We'll now have live session in the next week on Tuesday, where we'll be starting the chapter of capital gains, one of the most important topics. And yes, guys, within this week itself, please finish your PGBP chapter. Your PGBP should come to an end in this week itself. This is the last week which are given to you for completing the PGP chapter. Next week, you are going to start capital gains and finish it ASAP, as quick as possible. All right, sir. We'll be meeting in the next session. We'll be meeting on 25th of April for the test. And if you want to join the WhatsApp group, where link of the test will be shared to you, the WhatsApp group is at 9643929913 is the WhatsApp number, where you will get the details of the test. The details will be given in this on this particular number. So just join the group and have the link of the test and give the test regularly, guys. Now test will happen regularly till your examination, which is in June. Test will happen regularly. So yes, guys, we'll meet in our next session. Till that time, all the very best. Bye bye and happy studying. And hit a like button, guys, before leaving the video. Hit a like button. All the very best and happy studying. Bye bye. Bye. Welcome, welcome, everyone.